what are investors looking at today? Chris Haynes, Head of Australian Equities at Equity Trustees Asset Management, is here to tell us what he thinks. And it's great to have your company, Chris. In particular, g'day, thank you so much for your time. I mean, in particular, like so many Australian investors, banks have caught your focus. I mean, what are you watching at the moment when it comes to bank stocks?
Yeah, thanks, Cole. Really, we've just been through a reporting season, and we've had really good results. We've had, asset growth, profit growth, expanding margins, good control on costs, and this time round, no major disasters or regulatory issues. So things were pretty good. The only bad thing was the prices went down. Stock prices went down. So and that's all about the outlook really. And we're seeing the NIM story sort of is over. So we're now seeing pressure on deposits as well as mortgages. So that really came to fruition. So some of the brokers have pulled their numbers back, and we're also a bit worried about bad debts going forward. So one of the first rules of a banking analyst is you don't really want to own a bank when bad debts are rising. So we had a very benign period of bad debts, and those interest rate rises put through by the Reserve Bank and consequently by the banks themselves. They haven't really hit the consumer yet, so the consumer's been pretty resilient. So we worry about that with the banks, and it's hard to see earnings growing over the next couple of years. So. But it's not all gloomy. The banks are in a pretty good shape. They've got good balance sheets. They're well provisioned, and pleasingly, they're not that expensive, other than CBA, which is always perennially expensive. But they may get a little bit cheaper, I think, over the short to medium term. So we hold banks in our portfolio. They're not an overweight position, but they do provide our client base with the dividends. But you've got to be careful about banks in this environment.
I suppose, can we talk about where the risks might be skewed? Because, I mean, in global markets, the theme has very much been around credit growth, and that stems more from perhaps stability issues in the United States, which aren't quite as pertinent here because, if I do say so myself, we have probably a little bit more stable banking system. But I mean, there is still this notion that effectively the higher price of debt will mean that there will be lower demand for credit. That won't be good for banks, I suppose, the broader economy too. So, I mean, are you seeing sort of risks to the credit outlook, significant risks to the credit outlook that could mean that the risks to the bank stocks are skewed a little bit more to the downside?
Banks are not growth businesses. So the regulator has done a pretty good job in Australia pushing out risky debt to the non-bank sector. So that's a sector we do have to worry about. But I think you're spot on there. I mean, it's very difficult to see a lot of volume growth over the short to medium term for the four majors. And there's a lot of competition out there. Macquarie's done a very good job in the banking, in the mortgage market, and that's the big chunk of their business. And the banks have pulled back from that, a lot of that commercial real estate credit, which is that's the area to worry about in a bad debt sense. So there's no growth in that area for the banks, but less risk, I suppose. So yeah, they're not a growth business, so you need to have some growth in your portfolio, and the banks are more an anchor point for income, those who want income.
So on that question, I mean, me and I'm sure many others in terms of retail investors first learnt about the concept of value traps by getting caught in one of the banks, perhaps at an unattractive price. But we talk about dividends because they are important, but they're important to obviously, I suppose, invest in at the right valuation. So, I mean, do you think if you are looking for dividend opportunities in the banks right now that, that there are sort of viable investments currently, or do you think that, again, because of the circumstances you've just outlined, that maybe the valuations are still relatively rich here?
Look, I think the consensus is really CBA is the quality franchise and trades at a fantastic multiple. So those who are disciplined investors find that one difficult to buy. The other three around 1x book, and usually when things head below 1x book, that's when they become good value. I don't think we're a little bit away from that, and that's usually some type of event which triggers that trading below 1x book. So there's a bit of downside, I think, especially because we don't really have line of sight vision on on how the economy is going to end up, and that's going to flow through to bad debts for the banks. So even though those commercial real estate portfolios that they have, which are very small compared to history, that's where all the trouble is going to surface. So we don't have a line of sight for that. So you could expect pricing to become cheaper, I think, Lyle. That's a good point.
So just wanted to shift the tone a little bit, just to talk perhaps a little bit more about factor investing, because you did allude to it before about getting, I suppose, a combination in your portfolio to be able to take advantage of growth opportunities, but also, obviously anchor your portfolio around potential income generating assets. So, I mean, how, for the folks at home knowing that, again, they're sort of retail investors, they're looking to try and obviously learn the lessons from the pros to be able to apply it to their own portfolio. I mean, how do you approach that when you're managing your investments, that getting that sort of balance between factors, especially at different stages in the economic cycle?
Yeah, look, we have an approach which we call quality at a reasonable price. So we're looking for quality businesses at reasonable prices. So we got to have some growth in your portfolio, and I think with the when interest rates rose, we saw quite a lot of growth stocks pull back in value because they went to sort of astronomical levels. So we've been able to take advantage of that and put some more growth in the portfolio because our clients are predominantly endowment and foundation offices that they need income, but they also need their capital to grow as well. So just getting that combination is right. And you're right, banks can be a terrible value trap. And over the last 20 years, if you just been invested in banks, you would have wouldn't have done very well relative to the market.
One final question. I did want to touch on that matter of charities and endowments. A really interesting way of investing in the world, a very interesting, I suppose you could say, part of the investment ecosystem. But I mean, what are they looking for today in particular? Because we are, I guess, getting that sort of seismic shift in investing where I suppose there was the 2010s TINA trade where the effective lower bound, rates at the effective lower bound meant, you were seeing kind of money flow everywhere and asset prices being pushed up. But it seems not so simple right now, these charities and endowments sitting on big piles of money. I mean, how are you sort of talking to them about investing right now? And again, what are they looking for?
Just to give you an example, we have a foundation called the Vertel Foundation, which provides charitable donations for research, medical research, and also the Salvation Army. So it's a fantastic foundation. They want income, but they also want capital growth. They want it all. So you can't have it all. So you've got to get a bit of a combination of both. But you want that capital to grow, and you've got to be careful not to be, sucked into high dividend stocks. So that is an issue. So, I mean, the benefit of these charitable foundations, they do have a long-term view on things. So, I mean, they are more skewed to equities, which you might not think is a natural way to be. But given their long-term outlooks and the long-term nature of equity investments, that's predominantly where they are. We're a pretty conservative manager, so we're not a deep value and we're not a high. We don't pursue high growth stocks. We're quite conservative, so. We have the view that if we invest in quality businesses, then if we get the pricing wrong, then the quality business will eventually make up for the pricing. But hopefully most of the time we get the pricing right in terms of entering those stocks.